Hey everyone, welcome back to Corporate Decoder, the place where we decode the complex language of corporate finance to uncover the real stories behind the numbers. We'll be diving deep into CSX Corporation's filing today. And let me tell you, it has got some interesting plays in the earnings playbook. Before we jump in, make sure you are subscribed because we are always digging into these documents to give you the edge. And if you want to chat about these findings with other finance enthusiasts, join our Discord community, linked down below. Alright, so CSX Corporation's latest report covers the quarterly period ending the 30th of September 2025. Think of it like a financial check up for the company between their bigger yearly reports. When we look at their income statements for the third quarter of 2025, we see revenue was about $3.6 billion. That is a slight dip from last year when it was just over 3.6 billion. Now this might sound small, but in the big business world, even a small drop can signal something. On the bright side, their net earnings were $694 million, which is quite healthy. Moving over to the balance sheet, things get interesting. As of the 30th of September 2025, total assets stand at a massive $43.3 billion. That is up from $42.8 billion at the end of 2024. They have a lot of properties worth over $53 billion. Their liabilities are also substantial at over $30 billion. A key takeaway here is their retained earnings are over $10 billion. That shows they are keeping a lot of profits in the company, which is generally a good sign. Now let's talk about cash flow, the lifeblood of any business. For the first 9 months of 2025, CSX generated $3.2 billion from its operations. That sounds great, but it was actually $3.8 billion in 2024, so there is a noticeable decrease there. A big reason seems to be paying out $429 million in previously postponed taxes. That is a significant chunk of cash gone. Looking at the shareholders, equity, we see that net earnings for the first 9 months of 2025 were $2.1 billion, which is solid. However, share repurchases cost them $1.3 billion and dividends paid were $730 million. This suggests they are returning a lot of money to shareholders, which is usually a positive, but it does reduce the cash available for other things. Now into the notes which give us the juicy details. CSX operates in chemicals, agricultural and food products, automotive, and more importantly, they are a major transportation company mainly through their rail network. Here is a number that catches my eye. The company has casualty, environmental and other reserves. As of the 30th of September 2025, these reserves total $470 million. These are essentially funds set aside for potential future costs related to accidents and other claims. This indicates they are preparing for potential liabilities, which is prudent. This section discusses legal battles and liabilities. They are involved in various legal actions, including environmental matters and a significant one related to fuel surcharge antitrust litigation. While they believe these won't materially affect them going forward, it is something to watch. They also have significant insurance coverages, but acknowledge that future claims could exceed existing coverage. CSX has significant debt obligations. As of the 30th of September 2025, their long-term debt is over $19 billion. They did issue $600 million in new notes in March 2025. They are also using interest rate swaps to manage risks associated with fluctuating interest rates, which is a smart move in today's economic climate. Let S break down where their money comes from. In the third quarter of 2025, chemicals made up about $697 million of their revenue. Agricultural and food products brought in $382 million. Coal revenue was down about 11% compared to last year. This decline in coal is a bit concerning as it is a major part of their business. Intermodal revenue, however, saw a slight increase. Now for the management S discussion and analysis where they tell us what is going on in their own words. For the third quarter of 2025, revenue decreased by 1% year over year to $3.6 billion. Expenses, however, went up by 10% to $2.5 billion. This is a key point: higher expenses eating into revenue. Operating income dropped by 20%. This table shows us how much product they moved and how much revenue they made per unit. Chemicals volume dropped by 7% and revenue decreased by 4%. Coal volume also dropped by 3% and related revenue fell by 11%. This confirms that coal is a significant drag on their performance. On the positive side, minerals volume and revenue both increased. Looking at what is driving those higher expenses, labor and fringe costs went up by $9 million. Purchase services and other jumped by $54 million. A big chunk of this increase is attributed to inflation, technology contract restructuring, and costs related to network disruptions. And then there is the elephant in the room, a $164 million goodwill impairment charge related to their trucking segment Quality Carriers. This is a substantial write-down and indicates that segment is not performing as expected. CSX also provides what they call non-GAAP measures or adjusted results. They do this to try and paint a clearer picture, excluding the impact of things like that goodwill impairment. Their adjusted operating income for the third quarter of 2025 is $1.25 billion, a significant jump from the reported $1.08 billion. This adjusted view shows a stronger underlying performance if you exclude that one. Time charge, but it is important to remember the impairment still happened. They also talk about something called economic profit, which is basically profit generated above the cost of capital. For the first 9 months of 2025, it was $1.28 billion, a decrease from $1.86 billion in 2024. This signals they might not be generating as much excess return on their investments compared to the prior year. Free cash flow is crucial. For the first 9 months of 2025, it was $1.06 billion, a big drop from $2.2 billion the year before. Again, higher property additions, including over $440 million for rebuilding a subdivision after Hurricane Helene, and those tax payments are the main culprits. They also provide operational stats like train velocity, which improved by 2%, and dwell time, which improved by 8%. These operational improvements are good signs hinting at efficiency gains. Safety is also highlighted with a personal injury frequency index improvement. In terms of liquidity, CSX has about $618 million in cash and short-term investments. They have a $1.2 billion revolving credit facility, which they are not currently using. Planned capital investments are around $2.5 billion for 2025, with additional costs for Hurricane Helene rebuilding. On the balance sheet, total assets increased driven by property additions, but cash decreased. Liabilities increased mainly due to new debt issuance. On the flip side, shareholder equity also increased due to earnings being higher than dividends and share repurchases. Their working capital, a measure of short-term financial health, is negative, meaning their current liabilities exceed current assets. But this is not uncommon for large companies with short-term working capital needs being managed through other means like their credit facilities. Now let's talk about the story here. CSX is a vital player in American transportation. They are investing heavily in their infrastructure and clearly trying to manage risks. Revenue is mostly stable, but expenses are a growing concern, and the decline in coal revenue is a headwind they need to address. The goodwill impairment in their trucking segment is a red flag signaling that this part of their business is struggling. However, their focus on operational efficiency and safety is commendable, and they are returning significant cash to shareholders. Looking at the numbers broadly, CSX is a massive operation with a lot of moving parts. Their core rail business seems fundamentally sound with good operational metrics. The challenge lies in managing rising expenses, adapting to the decline in coal, and turning around their trucking segment. The significant investments in infrastructure are necessary for long-term health, but they do impact free cash flow in the short term. What is most interesting is the contrast between their reported numbers and their adjusted numbers after removing one-time events, like the goodwill impairment. While the impairment is real, it does paint a picture of a segment that is underperforming. The company's strategy seems to be focused on long-term infrastructure and growth initiatives, even if it means short-term pain in terms of free cash flow and profitability in certain segments. It is a classic balancing act. So is CSX a buy, hold, or sell? Based on this report, their core rail business remains strong with strategic investments in infrastructure. However, increased operating expenses and declines in key revenue streams, like coal, along with the underperforming trucking segment, warrant a cautious approach. Their ability to manage debt and continue returning capital to shareholders while navigating these challenges will be key. I'd say they are in a solid position to manage, but investors should keep a close eye on those expense trends and the turnaround in their trucking division. Alright, that is our breakdown of CSX's latest filing. What do you think about these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.